Good morning, everybody. Welcome to the Flow Show. It is Tuesday, the 12th of August. And, well, we've got a few things going on, but otherwise it's a bit quiet, very quiet in Japan. 10-year government bonds haven't even traded all day. First time since March 2023. So looks like summer markets are here. We'll get stuck into all the rest of the news shortly. Firstly, I just want to make you aware we have got our next round of offers going on for trading analytics. If you sign up to our newsletter, you can win a $25,000 TFP assessment account, trader funding program assessment account, and I should say, a free coaching course with one of the team. So if you sign up, you will be in the draw for that at the end of the month. If you've already signed up, don't worry. You'll automatically be entered into that draw where you'll get our next update on what's coming at Trading Analytics. So make sure you sign up there. Let me get the linky dink for you and pop it in there. Boom, in the Zoom chat. Morning, Kay. How's it going?
Morning, Ryan. Morning, everybody. Yeah, it's going all right, mate. Getting ready for the CPI. I guess since it was Mountain Day in Japan yesterday, they are still coming down from their mountain, and that's why they didn't trade any JGBs today. But it is, let's face it, it's quiet in JGB land right now.
Yeah, so yeah, definitely got that summer market feel to it in between these events that are going on. Right, one event that has been going on is the RBA. They cut their cash rate by 25 pips as expected. Well, the expectations got it right this time. So now they have their rate at 3.6%. They said inflation has continued to moderate. Underlying inflation is expected to return to the midpoint of the 2 to 3% range with a gradual cash rate easing path. They say rate cut was driven by declining underlying inflation and easing labour market conditions. 2025 growth was cut to 1.7% from 2.1% previously. Governor Bullock was a little bit of a mixed bag. Couldn't give up completely her undovish self, but added some dovish stuff as well. Started off saying there was no discussion of a larger rate cut. Then said we may not need to reduce rates by much. Estimate their neutral range in the 1 to 4% mark, which is wide enough to drive 2 double-decker buses through. She said the forecast suggests the cash rate may need to be lower for price stability. So that was the dovish tilt, and that our forecasts are dependent on more rate cuts. Overall, not pretty much as expected. Maybe a slightly dovish tilt, but not that you'd know it from Aussie dollar. Barely managed to move 30 odd pips in amid all that, but it does seem that they are potentially going to continue with their rate cut path, though at what speed we do not know. Kay, any extras for the RBA?
Yes, I was up, and why I did it, I'm not really sure. No, yes, she is gradually shedding her hawk wings or fangs, should we say, perhaps, because she said something in that the forecasted or the most likely scenario now takes into account or is based on a further rate cut. So that was a bit on the dovish side of things. But then there was very little to really be hawkish about. So yeah, I think it's not too far from what we expected. Yeah, like a kind of whatever you want to name it, 25 BPs cut, and here we are. Yeah, Aussie reacts a little bit on the news, then stabilized. I think the market is already looking at the US inflation, and that is now done. Now, dollar side, we may argue there's a bit of space now in between the rates, a bit more than there were before. But still, if you look at Aussie 10s and US 10s, they pretty much overlay give and take, just a couple of BPs. And yeah, I don't think there's an awful lot to take from that meeting, mostly as expected. Yeah, the neutral rate makes me think about ECB's neutral rate, 1.75, 2.25% with a 3% error marriage, error. What am I saying? Error margin, and that's where they all are now, the central banks, I guess.
Yeah, absolutely. And all these banks that still have rates, or did have rates up near the 4% mark, still want to get them down. Right, moving on from those clowns, we've got a bit of data out from the UK. We had the jobs numbers, and overall not too bad. I think this was a case of it could have been worse, but wasn't. So we got the claimant count, actually a positive number coming in, down 6.2, was expected to see 19, just under 20,000 claiming. So that's a better number. The unemployment rate stayed steady at 4.7%. So that was a positive in itself, that it didn't get worse. The employment change, 3-month rolling month to month, 238 versus 134 previously. Payrolled employees change was down 8,000, which was better than the down 20,000 expected, and the prior 41,000. Wages, there or thereabouts. If you take out bonuses, wages came down a bit more than expected, 4.6%. Was expected to be at 4.7%. Sorry, that was including bonuses. If you exclude bonuses, we stayed steady at 5%. This is June data for the wages, so it's a bit behind. And there are still some pay deals that came in August in the public sector that have probably got to filter through to this. But wages not coming down as quickly, perhaps, as the Bank of England would like, although they did mention that wages had been softening, so they might have had a little bit of a heads up to this data last week. Vacancies, according to the ONS, fell by 44,000 or 5.8% on the quarter to 718,000. So we're still seeing some of that weakness in the jobs market, people not as active looking for workers. So I say overall, probably a report that could have been worse but wasn't, which has meant that the pound has remained fairly supported after all that stuff. We'll have a quick look at the quid, just to see what I mean, and euro sterling. As you can see there, the pound gaining in that. We're just nudging down to the start of some support from 86.20 down to the figure where we went a week or so ago. Any thoughts on that jobs data, Kate?
Could have been worse. That's I think the main take that we have to get from it. Yeah, that sterling is starting to defy the laws of gravity again. Yeah, there's not much else to say really that it could have been worse. This is not giving us any hints at what the next move could be from the Bank of England. Take those numbers at face value. You would rather say they're going to be kept on hold. Wages are still pretty okay. Claimant count is improving a little bit. Stable unemployment rate. Yeah, maybe better than what could have been feared.
Yeah, exactly. If we look at that unemployment rate, you can see it is been on the trend up. So that will be the concern, or is the concern for the Bank of England. They don't want it getting up too high, but whether they've got any chance of stopping it remains to be seen. But anyway, right, moving on. Germany, all tickety-boo over there, according to the zoo. Economic sentiment coming in much worse than expected, falling from 52.7 to 34.7. That's the expectations number. The current conditions number also much worse than expected, minus 68.6. So all this positivity that we got regarding this fund that they're putting together, though I will concede that probably haven't seen the start of that spending, but you would expect at least some of the sentiment data to be picking up on the back of that. But it hasn't happened, or it happened for 1 month and then washed out the next. Zoo say that the outlook has worsened, in particular for the chemical and pharma industries. They say mechanical, engineering and metal sectors, as well as the auto industry, are also severely affected. Financial market experts are disappointed about the announced US-EU trade deal, the one that isn't even signed or on paper yet. So no let up for the lack of enthusiasm in Germany, Kay.
Yeah, exactly, mate.
This investment that the likes of Deutsche Bank and so on are putting forward, but each month that goes by, the more heavy lifting it's going to have to do.
Yes, but I would still say it can have a decent impact, but we just have to know when that money is going to be put to work. Obviously, the trade deal was a big negative in those numbers, so it's only half a surprise that it went down. The current conditions, expectations, sentiment, whatever. Yes, for as long as that, yeah, as we said, that money isn't be put to work, then the numbers could remain sluggish because we said it, and I was talking about it. Actually, you were off, I think, the week that we came out of that signature. It's not a good deal. So now, whether there are more negotiations possible remains to be seen. But those data are going to be pretty linear with whatever happens on trade, and then that money. I think if they put the money, when they will start to put the money to work, those numbers should see a material improvement.
Well, I might take the other side of that. I don't think we're going to see any sort of big boost to the German economy, such is the way infrastructure spending like that works. It's split over such a long time that you'll be very well based to actually see a significant uptick, shall we say, in GDP outside the initial outlay when it starts happening. But we remember what happened with Biden's blue wave and what that did for the US economy at the outset. Anyway, we had the Eurozone Zoo as well, which came in worse. Shock, 25.1 versus 28.1 expected and 36.1 previously. Over to the US, and yesterday, apparently there was about 10 people in line for the Fed job. We've had a bit of confirmation that some of those numbers within that 10, apparently according to sources, direct knowledge of the Trump team, Bowman, Jefferson and Logan are in the hat for the Fed job as well. That's added to Bullard, Waller, the 2Ks and Summerlin. And obviously we've got Mirren, who's doing it temporarily. Still wouldn't rule out maybe something permanent happening there, but all the names are slowly coming out. The White House reckons they are on track for their announcement of the new Fed chair this autumn. Whether Trump can sit on his hands for that long, once they've picked their candidate, remains to be seen. But as always, we'll probably get it sooner rather than later. But just some other names: Bowman, Jefferson, and Logan. Well, Bowman's obviously in place. Jefferson's a Fed, and Logan was a prior Fed as well. Both the US and China confirmed the 90-day can kick on the tariffs that was signed, sealed, and delivered by Trump yesterday. India are still hopeful on US bilateral trade talks, according to an India government bod speaking to a parliamentary panel. So things may not be dead and buried. Modi's been busy on the phone. Hope he's got some decent air minutes because he was speaking with Zelensky yesterday about sanctions against Russian oil. Right, over to the risk thing. And Germany is apparently organising a virtual meeting of European leaders to talk about Ukraine on Wednesday ahead of a European call with Trump. Zelensky EU and NATO officials will take part in the European call. This is the coalition of the wombats getting together again and getting busy into that summit on Friday. Trump has called the meeting on Friday as a feel-out meeting, but he's expecting constructive talks with Putin. Says there will be some swapping and changes in land, and he's going to try and get some territory back for Ukraine. He's going to look at all the parameters in that meeting and any deals that they want to do, and so he may leave and say good luck. So that's a bit of we'll call it a shocking comment, but it just shows that if he doesn't like what's going on, he's going to turn his nose up at it after that meeting and let them get on with it. That is probably the big risk from this thing, that nothing comes of it and Trump walks away, and then we're going to see risk probably get hammered. Some clarity for gold. It will not be tariffed. That was it. That's all Trump decided to say. No details or anything else. He just put up a truth bomb saying gold will not be tariffed. He's also picked his next commissioner for the BLS, a Dr. E.J. Anthony, whoever that is. No idea. Care even less. But that's who's apparently going in the role. That's it on the headline front. Kane, has you got anything else?
No, I think that's all right. No. Has to be noted that he did not, if those Fed names that have been added, it's I thought they would all be like the dovish ones. Jefferson is one, but Logan, for instance, is not really known for being too dovish a lady. So that's maybe half a surprise. But anyway, I mean, whoever gets that job is probably going to have to listen to the Orange King, right? No, for the rest, nothing much on that. On that gold, it had a little bit of an impact as it came out, but I think there's other stuff now going on. When there was that mix up, or I was like actually wondering why gold should be higher if they start to tax it. So but yeah, came off since. But we're ahead of interesting levels there. I'll have a look at it. No, I think you covered everything, Ryan.
Yeah, thanks very much. And yeah, gold indeed. We're still twirling around this 33.30 level. It's a bit like it's becoming a bit of a magnet, K, this
And
level.
if you look at, I was talking about it, and if you look at the rest as well, okay, things are moving inside, but we seem to be in a bit everything, in a wait and see, because if you look at the amplitude of the moves, they are gradually becoming less. And we're seeing it in quite a few instruments as well. Yeah, we couldn't get above 3400 or stay above 3400, then came back down. But now here again, if you look exactly on that picture where you are, we are entering this zone here down to. You can even argue that it goes down to 32 and a half, but if you look at it a little bit zoomed in, it's really down to 33.10. There's a lot going on as well. 32.85. There's this zone has been traded so much. I'm not sure I want to be really betting on the next direction from here. Obviously, CPI a bit later will play a role in everything.
Yeah, and I talked about this a week or two ago, particularly with my mate Mr. Brown. When you're trading summer markets, you've got to be more patient. You've got to look at these events like CPI, and as Blake mentioned as well, wait for your levels. Don't go chasing around. If you've got ranges developing, and no matter what the news, FOMCs, NFPs, whatever, we can't break out of those ranges or hold breaks out of the ranges. Those are the levels you need to be trading. Okay, so wait for your levels, use the events. If CPI causes a move in gold down to 32.60s, 32.50s, you got to think to yourself, well, is that data going to be enough to break it? So if you want to trade, that's your low risk place to trade. Sorry, mate, you going to say something?
No, I say or trade very much faster and then don't even think about what's going to happen next if you want to trade the ranges.
Yeah, exactly. But I'd rather take the pricing approach than try
Yeah.
and work around in the middle of things personally. But each to their own, as we say. Everyone's out to trade their own way. Right, where shall we go? Well, as I said, Aussie dollar not doing an awful lot. It's staying in there. It might start just creeping down. Probably going to be more of a dollar thing than anything else. But with the RBA slight turn, we're probably going to see, or probably have seen, expectations picking up for further cuts. The levels are pretty solid. Again, these are levels that have been respected time and time again, on and off, on and off. 64.80s is the next one that we're going to be tapping on, and then down towards this 64, 40, 50 area again, which was obviously the decent break point where we had a lot of resistance previous. But again, as Kay's saying, this is all very, 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 very tight. No real willingness to go anywhere. Resistance up at this zone looks like it's going to be pretty solid. So if we get a crappy number for the CPI data, that's going to be one area to look at. My options looking a little bit worse off than I took yesterday. I tapped in a very small 66 call just in case the RBA wobbled and stayed on hold for the cost of 12 pips. I'm not that bothered because we may be 30 pips off in the spot price, but my risk is still only 12 pips. And I'm going to be keeping this in case we get a surprise positive news out of the summit on Friday. That may be a weekend gap move, so we'll see what happens with that. But yeah, I might add a little bit towards the latter part of the week, seeing where prices are going into that. It will be another cheap one from there. Dollar MEX, that's having another little push up after having a test down in the 1855s, but here we go, get to your first half decent level and it's banging its head already. So this one might be just balancing out a little bit, but it's still looking very iffy as to whether we do break under that 1850. But it's held another test down towards it, which is a bit constructive, but we're still not out of the woods yet. Needs to get above this 69 line, and this is still only short-term stuff going back a couple of weeks. Bigger levels to be seen around the 80, 82s, this old fib level, 77s, or the 50 retracement. But nothing is nothing unless we're back above 19. So 18, 50, 19 would be the wider range to potentially trade in these quieter moments. Yeah, go on, mate.
That one could be a mover on CPI this afternoon. And if you look at rather the top side, as you guys are looking at, a core above 3% could be a clincher to go and have a look up at the high 18s again. But again, if we get a miss, because the market is really expecting a sticky number, right, today. If we get a miss, though, then maybe the 1850 will come under fire. If we get a decent miss,
yeah, exactly. If we do get a move up into the 1870s, I'm probably going to chop a lot of my higher longs that I've got on play just to reduce them off the books and keep me lower 55s. But again, this is where you get the test. If we get a poor CPI number and it goes down and tests these lows and holds again, that will just be building the case for the support picture. But also, if we do break it, there's going to be probably enough stops building from people who are buying all these little moves that if we do get a break, it's going to be fairly significant. So that's where it gets me thinking about adjusting my trade, maybe reversing my longs to shorts, adding to my short position. Oh, not that. And then seeing if we get a big break. Ali, what is the impact of Trump giving positions to US NFP replacement and CPI? Can Trump force a new person to change data? No. A lot of people are making that assumption. No, not really. The data is the data. It's collated from regions, from other central banks, from businesses. It's a big machine data collection in the US. It's not one guy with a spreadsheet going, right, I'm going to fit all these numbers. Plus, CPI is different to NFP. So, yeah, I wouldn't I wouldn't go down the conspiracy theory route that some people are going down regarding that. The only thing that will change is if Trump, I don't know how it works, will enact different ways in which CPI is calculated, things like that. That's probably his only influence he can have on it. But I'm not sure what influence he has. Yes, mate.
Take out all the positive numbers.
Yeah, exactly. But it'll be a massive credibility issue again if he does tinker to that degree. And probably Besson is probably the calming factor in that. He'll know what US data means and having it as reliable as it should be and not to fuck around with it. Right, Kate, nice to know. I'm going to pump it over to you, mate.
You.
If I can do it properly. There we go.
Okay. Go over a few of the majors, right? Euro dollar we have seen a couple of times that 116.80, 70.80 pop up here. And I think that's going to be the first level that we need to watch in case we get a surprise. To me, the surprise trade for the afternoon is if we get a weakened number, okay? 3% in the core CPI, anything there or above will obviously put some upward pressure on the yields and likely put downward pressure on the euro dollar, because then the market will look at a prolonged or thinking at least about a prolonged period of higher CPIs, because the impact of tariffs may still be gradual, and if it's already seen right now, the expectations for higher yields and higher inflation on the back of it may be coming a bit stronger. So we could see that immediate effect lowering the euro dollar, which should bring us in theory back somewhere around 115.64 a starter. But why not if it's really a number markedly above the 3% line? Right down to 115, who knows? And there we will need to, I think, reflect on those on what's really happening. And again, last time, if I'm correct, we had a certain number, and then the unrounded numbers came out, and then the market was doing something different, and then at the end of the day, everybody lost its head, and I think, if I'm correct, we came back roughly to the middle where we were before. Option market is again not overly ecstatic about this. 50, 60 pips up and down are covering the expectation. So that's exactly from where we are here, that would give you exactly your 114, 50, 60, give it a few pips, and the 116, 70, 80. So expect a bit of interest on both ends if the number drives it up or down there. If we really get a number that the market is not expecting, that is like really a weak one, weaker than prior month. Let's put it that way. Weaker than prior month, then it is possible that euro dollar sees a quick push up into that 117, 117. 1530, even stretch it up to 17, sorry, not 15, 17, 1530, 50 zone. But remember, the 17 and a half, if you go on the really long term chart, is still an extremely important level. So it's going to be have to be a weak one to really push it up there. And I wouldn't say beyond unless it comes in really weak, because if it comes in really lower than expected, then the market will for sure remember what the NFP, and they will put one and one together and say like, okay, now we are on a path lower, and that could be the driver here. But as Ryan already mentioned, we are still in summer markets. Are we going to get that much is a bit the question, obviously. Okay, so be careful if we get up into that zone. It could be warranted to shoot up there. Also, some liquidity also means that perhaps a little bit less liquidity, so we could see a move up there. But then be careful. It's because it has to be decision time, and I'm not sure whether the market wants to make big decisions right now. If you look at the dollar yen, it's still bit. I'm talking about that so often. It's very, to me at least, still it's very hard to be really long yen right now. Whenever nothing happens, it's just gradually pushing higher. So get a strong CPI number here. I suppose this 148 6075 is going to be toast. We are actually not too far away from it, and we will need to have to look at a bit wider numbers here. And those wider numbers, they could be seen around 149 and a quarter. But looking at the volatility that we can have in yen, if really the number is very sticky, that means a higher CPI number, which is going to push the rates up. We know that this is always an important factor for when trading yen. Why not see 150, you know? So I would be really careful. I would not counter trade a move if really the CPI is very sticky. If it comes in a little bit weaker, and then it's going to be interesting because I've been talking so often about if you look at the yen, you have to look at the crosses as well. Crosses are bit, as we have seen this morning. Euro yen is again higher than yesterday. Sterling yen is a particular one which nearly hit 200 again. If it's a softer number, not saying like a very weak one, yeah, but just a softer number, we could see a move lower in dollar yen, but it's probably not going to go as far as other pairs in the end, because softer CPI data will probably underpin the equity markets and will underpin those those yen crosses on a positive risk. So we could have the initial reaction, but then are we going to continue to go lower, same as the other pairs, or find some support here and the yen crosses will take over again? So I would say this one, the bigger lasting move is probably going to be on a very sticky CPI. Initial move can be very quick because of the volatility in the yen, but it could come in a zone here, let's say 147 three quarters, 147 and a quarter, 146.19 in this zone here. But we have seen this, they have tried it a lot of times, and then we started to go up again. And that could be the result of those yen crosses. And just to illustrate what's going on in yen, see the euro yen yesterday tried to correct, but then we are back at that 61.8, which is 172.30. We're turning really around there. And look at the yen crosses to get an idea about what what the dollar yen actually will do too. And this one is very interesting. If you look at this, we have gone up to 199.85 a month ago. Then we hit 199.97 or so about yeah, a small month ago. And now today we couldn't hit 200 again, which stopped just in front. So it makes me think that there's a bit of barrier action going on at 200 in sterling yen, maybe a no touch or a knockout or something like that. So be careful this afternoon. Be careful, especially again thinking about risk. If we get a risk positive number, both currencies here that we're talking about are risk currencies. We know sterling is a risk. We know the yen for sure is a risk currency, but sterling is a risk currency too. So a risk positive outcome this afternoon could see this really break above and then probably be on its way to perhaps 202. So be careful for this cross this afternoon because it has capped. There is seemingly defense there. But watch out if it breaks. It could be pretty explosive, that one. Moving on to the cable, Bran, one from your special, right? We're turning around this zone here. Obviously, euro sterling being having come down, it's supporting the cable. We're between this little level here. I think for the afternoon, three levels to really look at. If you got an as expected-ish number, it's going to print a 3% on the core. So in sympathy, the dollar may strengthen a little bit, cable come down, but as you can see here, we halted a couple of times around 134, 15, 20. The next one will be 134, the figure, but again, 133, 65, 75. Okay. And I think in current context, it's going to have to be a really beat or negative also risk if CPI flies higher to really break this 65, 75. I think it's important enough 133, 65, 75 to. I wouldn't be surprised if it holds again unless we get really a very very high CPI print. What happens on a lower one? Well, it's been even against our assumption somewhere. It's been a bit the sterling of late. So this one here, 134 three quarter, will probably be toast. 133.90 as well. And then we are looking at this zone here, 135, 33, 38-ish, has been traded a fair number of times in the past as well. Right here, 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 here. It is a bit of a bit of a level here, 133.35 around, or 135.35 around. If it goes, then we are talking about 136 and 136 and a half ish, where I have a trend line coming out. But to do such a move, it's going to have to be a real miss on the CPI. Okay, as we've been talking over the show, we are in those summer markets. Are we really going to see much more than what we have seen as ranges? Okay, so the numbers should really be outside of expectations to really force those bigger moves right now. What else are we looking at, folks? Already looked at the Aussie. Kiwi, you have a position. Well, we're turning around the level here, Ali. Okay, bit of a trend line coming in, bit of FIB activity, just a 50%. If you get a good number for the dollar, it's probably going to go down. And actually, Kiwi is also somewhere a risk currency, we could say. So if we get a stronger CPI reading, we are going to probably retest 59 the figure and maybe 58 three quarters. It's encouraging perhaps for the shorts that we have. Whoopsie. It's encouraging for the shorts that we have kept 59, 65, 70. So if you're short, your stop is relatively clear up there. Okay, that is the thing that we could see. And well, just to give a quick look on the Swiss, we saw a bit of a setback on Euro Swiss. I think that is just a result of that. Okay, you're not going to be tariffed on those gold exports. 94 around is a bit of a support on the Euro Swiss, so it could already hold, but we have to break above this 94.35, 94.45 to really continue to go. Otherwise, we are going to unfortunately continue to range trade here. And the dollar Swiss is going to be a factor of euro dollar and your euro Swiss. It did go higher, but I really don't have a really strong view on this. Get a little of a weaker CPI, we're going to be back around 80, 65, 70. But yeah, it's holding that zone for the moment. Maybe what you can do is draw a line around here. And again, that support is going to come in around 80, 70, 80, 65. So it goes back down below there, maybe bad news. Gold, oh yeah, Ryan already looked at that. Silver, nothing to add, really, nothing to add. We are, yeah, banging our head, we can say, around the bottom line of the channel, but I'd still argue that silver is hanging in a bit better than gold right now. So get a bit of a weaker CPI. Maybe this one could actually outperform gold again. I'm not really inclined to do much with gold right now. And with that, Ryan, back over to you, mate.
Thank you very much. Good stuff as always. Last thoughts on the CPI. Know the market positioning, know the market pricing. We are pricing around 91% for a cut in September. So even if we get soft numbers, there's not much more dovish the market can possibly get. A lot of the banks still thinking that they're going to get 2 or 3 cuts this year. So it's a lot of it's priced in. So for me, the bigger risk is that we get hotter numbers, which then undoes some of that pricing. So as always, know what the market is thinking going into these data points. And with that, we shall call it a day. Thank you very much, everybody. I'm going to be off for the rest of the week, so I'll leave you in Mr. K's capable hands. Enjoy yourself, stay safe, and I will catch you next week. See you later.